Hi, everyone, and welcome to Mish's Market Minute. My name is Mish Schneider. I have not seen you guys in a while. It's been a very interesting summer, and I think very apropos that I would come back on a week when the market finally had a correction. So with that, we have a lot to cover, as I did a segment for you earlier in the summer about the second half of 20. What I expected, and pretty much it's starting to play out, which was we would see the rally come September, October, we might see the markets dip, and at the same time, the commodities market actually start to come together. So let's go through everything and see first of all, at what point can we say the market is topped? Did the market top on Thursday? What are the outliers telling us? What are the metals doing? And is it time for us to add more? Sorry about that. Raul didn't have a vacation. And where are the best opportunities? So let's start first of all with at what point can we say the market top? And so what we're going to do is we're going to go through the four indices, number one, and then we're going to go through the economic modern family with all the plugins that are still almost ready, but will be ready very soon at StockCharts. So we're going to start with NASDAQ. Now, of course, we know that NASDAQ has just powered up and powered up and powered up. All corrections were very, very slight, like this one that you see here, where it had a gentle step down for 3 days and then boom, right back to it. Today, not so much. Today was a pretty explosive sell-off, and not really a big surprise, considering, first of all, the VIX, which I didn't take a picture of and should have, but the VIX was something that was giving us a tell because it remained green while NASDAQ was going to new highs. And secondly, the TLTs, or the long bonds, which we will look at, were starting to creep up, or yields starting to go down. Even though the dollar firmed a little bit, certainly not that impressive at this point. So with everybody getting super bullish and the sentiment unbelievably strong, no surprise that today would be the day with what they call a hangman candle up here that we would see this sell-off. Now, technically, what this means here is that if you look at the top of the market, which was at around 303, this is a confirmed top type of situation, generally could yield about a 10% move. So what does that look like? Well, 10% would be a move down to 270. Would that be possible? Of course, anything is possible, but it's a general range between a 5 and 10% move when you see these topping candles, which means it could stop. Well, here, 270 is actually right above the 50-day moving average. I'm just looking at these numbers now. Sorry about that. So that would be actually almost picture perfect. So at this point, I wouldn't be necessarily in a big rush to buy, especially with a long weekend coming up. And one of the biggest catalysts, I think, is with the oncoming election, the social unrest, which is something I talked about at that midway point, possibly coming home to roost. But a move down to 270, particularly if it holds, would give you an opportunity at least for a very, very tight risk. And as I always mention, risk reward is everything. If we move down to the price performance, this is the plugins that will be available to you soon. You can see obviously it's still well outperforming the SPY, although it's come down a little bit. In terms of the real motion, you can see that actually it was going in line with the high 3 days ago. It made a high and then started to show a divergence yesterday. This was yesterday. It was coming off already as the market was making new high, and that's what makes this real motion so powerful. And of course, we'll see what happens at the 50-day moving average here if it gets that way, or if it holds this Bollinger Band and starts turning up, then perhaps was a one-day wonder. Anything is possible in this market. We also added another indicator here that I hadn't showed you before, which is volume performance. Basically what it is it's an average of volume performance that you want to see when something is going up. You want to also see a trend up in the volume. So you can see the trend was up, then they had that little correction that I talked about. The trend was back up, and obviously now the trend of the volume here is down, even though the volume was high. It was in divergence to what the actual move was. So let's move on now here. And I explained that all thoroughly. I'm going to go much faster from here on in because I have so much to cover with you. In the spider, same kind of thing. Topping pattern type right here with the high in the SPYs being up at around 356. So again, about a $35 move would put this at around 325, or let's say roughly around the 50-day moving average. Again, real motion. It actually was showing no divergence. It made a new high and a new high in real motion yesterday. So today it's actually in line. So there's no divergence here. And then, of course, the volume too has come down along with the actual price. And then if we move to DIA, also super interesting because this never outperformed the SPY. No, I shouldn't say never. It hasn't in a while. Certainly on this most recent rally, it still hasn't. It did go up in complete momentum with the price yesterday and has come off with the price as well, and the same thing with the volume. So again, is this type of action what we can consider to be a reversal top? Yes. The only way it gets negated now is if it comes back through the low of Wednesday and closes above there. Then we can say more confidently, and that's with all the indices, that it's a one-day wonder. Now, we also have IWM. Now, interestingly enough, with IWM, of course, this has never really taken off with the rest of the market, and you can see that we've just had this big sideways action. Also on a channel that I've shown you in past charts, it actually broke out of that channel at 153. So we're going to call 153 some level of support here, and we'll see what happens. And then the 50-day moving average comes in at 150. So I would be looking, if there's going to be any signs of health in the market, it would have to come from the Russells because the others went up so much. If it can hold between 150 and 153, that would be great. If not, it starts to break down under 150, then we're starting to look at the 200-day moving average at 145. This again has not outperformed the SPY in a while. And the momentum was certainly, there's no divergence there. It went up with the price and then today came off a little bit. And of course, the same thing with the volume holding right at support. Now, this is retail. Retail is another. So now we're into the economic modern family, IWM being the granddaddy, and of course, XRT, brick and mortar retail, although a lot of those brick and mortars have gone online, this being granny of the modern family. And again, just like what we saw with the others, there is a little bit of a reversal pattern here, but it has held some really good support with today's low. So we're going to look at 50 here because retail could still be an opportunity because even though we had some big sell-off today in the tech, which was overpriced, the consumer spending has still remained relatively robust, not just in the United States, but elsewhere, particularly, of course, on online, and people are using their stimulus checks to buy things. So that is why we want to continue to watch this as a good sign. And I remember before I left telling you that this was probably a good buy and was starting to take a lead in the market. So we want to see it continue to hold up, that along with IWM. Still, obviously underperforming the SPY. Again, the momentum showed a divergence here, though, yesterday, because you can see the high that was made here in momentum was at a lower price point than the high yesterday, where it started to come down a little bit in momentum. So again, this sell-off today, at least for me, was no major surprise. And the volume is holding pretty good too, relative to its price performance. Now let's move on to tech because this is semiconductors. And so you can see that again, I showed you a channel and I said if it got through 170, it was time for you to close your eyes. Well, if you close your eyes, it went up to 187. And that's why it's so important to have a plan for taking profits, which isn't something I've covered with you in past lessons. And again, we have one of those nasty sort of reversal patterns, which could show a move down maybe to about 167 based on a 10%, and again, right above the 50-day moving average. So I'm not saying when we ask the question, what does a top look like? Really, what we want to see is some follow through to today being a turnaround candle, which means it can't go right back up, number one, or the move is not over. And number two is if it goes down about 10% and holds the moving averages, then it's just a good, healthy correction. But if we start to break those moving averages and go into warning phases, then I would take that as fair warning. We can see here that it actually, for the first time in a while, underperformed the SPY. Here on the real motion, it actually also showed a divergence in that it was starting to come off on the dots, even while this was making a new high. So that was another big thing. Also on the Fibonacci sequence, not something that I do very readily, but this was very, very extended on the Fibonacci's. And of course, the volume now is showing signs of weakness as well. So semiconductors is important to the picture, But I'm really going to be watching that IWM and XRT. And this one too, this is IYT Transportation. So you had some plus in the cruise lines today, being Thursday, and also some pluses in the airlines. This is actually also going to be a very key sector as we move into this next few months of 2020. Now, again, it had a classic reversal pattern. This is the 10-day moving average, so it closed just on it. It's matching the SPY in terms of performance, and the momentum actually is showing no divergence, and the volume has come off a little bit. So if we add these inside of the market factors, Russell's, retail, and transportation, all Druckenmiller's words, something that I've been using for years and years and years, then we say that maybe if this can get back over 200, again, good sign more for a rotation of the market into the healthier areas and not necessarily just flying into tech. Now, IBB is another one, and we talked about IBB breaking out at 126 of the channel a while ago. It traded up to around 150 and change, and since then has done nothing but correct. Here's your 50-day moving average. So this is what I'm talking about. This is already in a caution phase, and the slope on the 50 is starting to move down. So that tells me that I wouldn't necessarily be a buyer right here. I would rather be able to get something closer to 124.55 unless it holds 130 and can close the end of the week over 133, then maybe you could use 130 as a pretty tight stop. This has been well underperforming the SPY, and the momentum is going down. And again, the reason why I'm not so keen on buying it right now is they're showing no divergence, and that momentum is going down along with price. And of course, the volume has been under the red line or the moving average for quite some time too. So you can see how well these all work out in terms of price, because at this point, had you been long IBB, this would have signaled you to get out somewhere around here. Now, last one is the regional banks, and money rotation has come into this, but is it enough? And that's really also going to be a big key right here. Are banks going to come alive? Possibly, but right now this is still underperforming the SPY. Momentum is holding well. In fact, momentum is showing a divergence because look, you can see it's over the 200-day moving average here and well below the 200-day moving average here. So right now, what we want to see, first of all, is 38 to hold. And if this can get back over, especially on a Friday, over 40 and hold, then maybe we will see that move up to 43. I would do it more as an active trade and then see what happens at 43. But I'm only encouraged by this right here, being the divergence in momentum. And look at the volume today. It took out the average and it's showing that it's matching the green price. So now let's move on to the outliers, because you can't just look at this market in a bubble anymore. You really have to look and see what's happening with the US dollar, with the TLTs, the 20-plus year long bonds, the junk bonds, and the high-grade investment bonds. Again, none of these topics should be strangers to y'all who've been listening, because I've covered these in the past. So let's start and look at these outliers, because this is going to have a huge impact on the market too. Now, I've been very bearish the dollar. I have mentioned that to you many, many times. And you can see that the dollar actually started to go down. And as I went on vacation here in August, it went down even more and made actually a new multi-year low and has popped back. So just the opposite of what I showed you here, this is a reversal bottom, which means sometimes you can get about a 10% move. And we're looking at UUP, but I like to use actually the DXY as the pricing of the dollar. But nonetheless, what's significant to me is that it made this pop, and today, or being Thursday, could not close above the 10-day moving average. So for the rest of the week on Friday, we want to see a close back over, say, 25.15 in UUP, and then maybe we'll continue to see a bit more of a relief rally in the dollar. If not, that will lead me to our next subject, which is the commodities, but we'll get there. Of course, this has totally underperformed the SPY. We're not seeing any real divergence in momentum other than the momentum has ticked up, so it's actually totally in line. And the volume, which has not been over this moving average here for a while, is going neck and neck. So the dollar can really go either way, and that's going to be a factor. Now, if we look at the Treasury bonds here, this actually closed right on the 50-day moving average. So not quite in a bullish phase because it has to confirm there for 2 days. So really still, if you look at the closing price, this is on the aftermarket here, it ticked a little bit higher, but it actually closed right under. It's still in a caution phase, with it's still underperforming and no real major divergence here. In fact, if anything, this is hovering on the 50 while this is still well below, so it's still showing some weakness. The only positive sign here is the fact that it's crossed over the moving average in terms of the volume performance to price. So this will be a big key. Through 167, maybe we'll start to see the yields go down and the TLTs test that 170 level again. And if it can and it continues to close, let's say under 164, then that along with a stronger dollar would probably be good for those areas I'm talking about, IWM, IYT, and XRT, and KRE, plus the financials XLF. Now, the junk bonds are one reason why it's very hard to get super negative right here. This is the appetite for high yield risk. And so far, when we had that low back in February, this thing tanked and then had a really nice bottom, and this is where we started to get bullish. And since then, we've actually gone into a golden cross here and in a bullish phase. So there's no reason to think at this point that the appetite for risk has really declined, and maybe that's telling us that today again was just a one-day wonder, and today again being Thursday. So this would be something else to keep an eye on. If it breaks the 50-day moving average, maybe then we can say, again, just like I showed you with the changing phases of the key indices, that we're actually seeing the top of the market. But at this point right now, I have to call it more of a correction and a rotation into things that are better. Just a quick look here, no real major divergence here at all, and still hovering on the moving average in terms of the volume. LQD, this is investment grade corporate bonds. So this is completely different than junk, but it was another area where the Fed came in and bought a lot. And they're still buying. This actually broke down under the 50 and now has come back through the 50 and the 10. So this would be something else that I think would be really important to watch. 136.27 is your 50-day moving average. Right now it has to hold there. If it breaks down, maybe we could look a little bit more negative. We want to see what happens here with its price versus the SPY. Now, interestingly enough, though, here's another place we're seeing a divergence because it's clearing the 50 on price, but it hasn't quite cleared the 50 on the divergence. So this will be something to look at for Friday, and especially as we head into next week. And then, of course, the price, the volume versus the price is also in line. So you're looking at those outliers. Basically, you've got the dollar that can still go up. I think a little bit of a bounce in the dollar may not be bad for the market. Too much, of course, would have a different type of impact. Market continues to tank. That's not really going to be good overall. And, of course, watch those inside sectors of the market. And, of course, let's see what happens here in terms of any kind of phase changes going forward. So next, let's take a look at the metals. And I'm going to talk even faster now because I want to cover what I've got left for you here. So let's start with the gold. I've been very bullish in gold. You know I've been bullish in the gold. We still have gold. We added to the gold. And now I'm looking again to see what happens with this. So one thing that's giving me pause is that this is over the 50 and the real motion is under the 50. So we're seeing that divergence. So what I would like to see is, even though the momentum went up a little bit, is I'd like to see this cross back over the 50, while I'd like to see the price not only hold 180 or even 178.50 where the 50-day moving average is, but maybe get back over 183. Back over 183, I might be willing to take a shot in this if I were looking for a new position. And the volume versus performance is pretty much sitting right on the line. In silver, we actually have a little bit of a different view here. And by the way, if you recall, if the silver gold ratio starts to come in favor more of silver, that's usually very bullish, not only for the metals, but an inflationary indicator. And I'm still looking at that stagflation scenario. And I don't even think that's begun yet. and will catch a lot of people by surprise when commodities totally explode. So with silver, we're back under the 10, well above the 50, and you can see how here we're also well above the 50 in terms of the real motion. So I'm looking possibly for this to come down to around 23, but if it doesn't and it gets back up over, let's say 25, 50, 26, that can be another opportunity to get long the silver. It's still underperforming the SPY, and of course the volume has shown a breakdown, but nonetheless, I would be looking at that 26 level. Now, GDX to me is the most interesting of the three because it now 2 days in a row has tested the 50-day moving average and has held it. So if we can get through, say, 4150, you have a really tight risk to look at this on a Friday, going home long the miners over the weekend with a super tight stop. I'd give it a little bit of room. I'd say it should really hold maybe 39, 50, 40. I like to give it a little room because these are areas. But nonetheless, this is showing me that there were buyers there right at that 50-day moving average. Hasn't begun to outperform the SPY. And even though it's held the moving average there, on the real motion, it's still under. So we are seeing a little bit of divergence. So that's why I want to see maybe a little bit more strength here. And I would be very encouraged if this got back over the 50. And of course, the volume patterns are also showing some weakness. So the price right now is definitely giving you a better information. All right, let's end here with some of these grains. This is really where I still think that we're going to see the stagflation come in. Still really good opportunities. I've talked to you about all of these, and all of these have made big moves since I've talked to you about it. So let's see where we're at right now. Let's look at the soybeans first. I don't see anything bad about this chart whatsoever. In fact, it looks like we'll eventually get a golden cross here. When I left you and last time I talked about beans, I had mentioned to you that we saw a divergence right here, that it was over the moving averages in real motion while it was under the moving averages here on price, and that as soon as it cleared, it was time to buy the beans. Hopefully some of you did, because you got a really super move, with today making a new high on this move. So you've gotten a dollar out of this. We've got a good strong move on the price performance. The momentum is strong and the volume is strong. If you were going to first get in now, obviously your risk isn't as good as it was, but I'm just showing you though, because if this really turns out to be a longer term trend, we could actually see these beans going much, much higher. Now here is DBA. Again, I showed you this over and over and over again, once again with the real motion and the divergence, how it kept hanging on to the 50. And the last time I talked about it, it had cleared the 50. And I said, as soon as you got a price confirmation or 2 days above the 50-day moving average, you could buy it with a stop down here. And even though there's some tax implications, there are a couple of other ETFs that don't have that follow the same path, one being PDBC. But I'm going to use DBA because all of our clients are in it and they got in well. And now you can see it's hovering here right on the 200-day moving average, which means that if it holds, you have a whole new risk here using the 10-day moving average. And of course, the volume came off and the momentum came off, but it's still strong and it's starting to outperform the spiders. And now if we move to coffee, this was another one I talked to you about. And this was another one that I showed you, I think maybe the futures, but this is JO, the ETF. And once again, it was showing a divergence here, down here on the real motion, clearing the 50, just when it gapped up higher here. So this was really your entrant day. Then it corrected all the way here, and now look at it. It looks like if it can take out 36, it's got more to go. 40, it's got more to go. Of course, the problem here now is risk, so you'd have to use this low and under the 10-day moving average. But I think coffee still looks pretty good here. And then last particular instrument to cover is sugar. And why do I look at sugar? Mainly, I like to look at sugar for a couple of reasons. One is it's my secret sauce formula to looking at the possibility of inflation coming in. There's all different factors for that. One being that sugar back in the 70s actually led gold and silver in terms of broadcasting inflation and back in 75, 76, when the metals started moving more like in 79, 80. And what happens in gloomy times, people obviously turn to sugar for comfort food. And of course, sugar being in everything, it's been overproduced. But of course, we're looking at this more from the psychological standpoint. And when again, before I left and I talked to you about sugar, this was also showing a divergence holding the 50 while it was still under the 50 and then cleared the 50. So you had a good opportunity to get long somewhere in here, take a little money off the table against the 200. And look what happened today. It actually closed right on the 50-day moving average at 591. So if it continues to hold 591, maybe I'd give it till Tuesday, and it gets back over, let's say, 6, if you really wanted to be more conservative, you have a good stop here. And with these ETFs that are thinly traded, you really want to make sure you use end-of-day stops. Now, underperforming the SPY. Also, though, even though it failed the 50 or held right on the 50 and the momentum has come down, it's still showing strength at the 50. And of course, the volume is showing some negative activity that happened today. So if we put this all together, basically what I'm saying is this. What are we looking at for the second half? We're looking at number one, the indices, particularly the Qs and the SPYs, holding up. If this is going to be a 1 or 2 day correction, holding those moving averages and then heading back up with a much tighter stop, or potentially selling off, showing us that the market is topped out. But that's in the sectors that have gone really, really high. We're also looking at some of the more value sectors like transportation, small caps, and retail, because that's the inside of the market. And also we have a situation where the value versus the growth stocks has not been this low except for twice in history, 1928 and 2000. So we could have an old-fashioned rotation into some healthier instruments. That would be great. Or it could mean that those instruments finally caught up a little bit to the Qs, and obviously not making all-time highs or anything like that. And if the Qs and the SPYs continue to fall, they're going to fall hard, in which case the whole market is going to collapse. And then, of course, we're going to look at the junk bonds. We're going to look at the high investment grade bonds. We're going to see if the Fed is going to keep coming in there to try to propel the market higher. We're going to look at the dollar to see what happens there. We're going to look at the interest rates to see what happens there. And then we're going to look to see whether gold dips more and silver dips more, and will silver maybe be a good buy versus gold, or we look at those miners and look at that 50-day moving average and the fact that the price performance right now is outshining a little bit of the momentum. And then finally, keep an eye on the grains, the softs. These are still, although they've come back a lot from the lows, they're still at a big historical low ratio compared to the SPY. And again, in our current environment with a supply chain disruptions, demand potentially increasing, people have to eat, etc. And the Fed already stating that they don't mind letting inflation go hot. Of course, food and gas is not even included in that. Then that could be another sign where my stagflation theory, as I said, we got into the second half of 2020 into 2021, gives you these great opportunities. So I hope that was a good summary as we are now back from our vacation. I will see you all again next week. Thank you so much for listening. As always, I love when you put comments into the YouTube place. I answer everybody's questions, or at least I try to, and I always appreciate the wonderful feedback. So you all have a wonderful long weekend, and I'll see you all next week. Bye for now.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.